All right, we're now recording. Okay, so the topic here is volume that we can see on the order book. This is the order book. What the reason it's called the order book because it literally is a book of orders. It's orders to buy and orders to sell, and they're listed bids on the left, offers on the right. Some people call this the ask, same thing. Bid, ask, or bid offer, whichever you prefer. Now, the only reason why stocks move in price, at least the mechanical reason, is simple. You have this stream of orders here. These are market orders. This is called time and sales. This column here. Okay, that's time and sales. What time and sales represents, it is interesting, but I'll go over that in a second. Time and sales represents a tracking, a record of every transaction that has occurred, whether it's a buy or sell at market price, but it also tracks any transactions that occur in between the bid and the ask, because sometimes the bid and the ask are spread wide enough apart where you can actually have a price that's in between them. For example, if the bid ends in 30 cents and the ask ends in 32, then the price 31 cents is in between the two. And if a trade takes place at 31 cents, that means that it happened above the bid but below the ask. And in this display, I have it programmed to show the anything that occurs in between as orange. Sometimes, you can change it to white, like in the older platforms I would use, they would have it in white to show that it's in between the two. Now, it doesn't matter what color it is. The only thing we need to understand is that if it's red, it means we sold at that someone did a market order to sell at a bid. If it's green, it means someone did a market order to buy at an ask or offer. And if it's orange, it means someone was in between. The transaction occurred in between. Now, for every buyer, there must be a seller. So when a market order buys, somebody has to sell to that market order, and it's the actual offers, the asks over here, that are the people selling to the buyer. So if I say I want to buy at market price, like it says up here, MKT, anytime you buy at market price, you're buying from one of the available offers here, the first one that's available at the moment you decide to buy. So that person who decides to sell must already be there before you buy at market, or else you wouldn't be able to buy at market. In other words, if you put a market order to buy but no one was offering to sell, then you don't have any way to do a trade. It'd be like trying to go to a dealership and saying, I want to buy a car. And they say, well, we actually don't have any cars in inventory for sale. And you say, well, yeah, but I still want to buy a car. And they say, yes, that's fine, but we don't actually have any cars in the inventory for sale. Right? So, that being said, in order for something to be sold, somebody has to buy. In order for someone to buy, someone else has to sell. So we call the offers and the bids passive buyers and sellers. A bidder is a passive buyer. A bid says, I'm here, and if you want to come to me and sell, I promise you I will buy at this price. And of course, they're required to do that. If you have a bid in the market and someone takes it, you can't take it back and say I changed my mind. No, if they sell to you, now you bought. Likewise, if you put an offer into the market and someone buys from you, then you have to sell. It's that simple. But if you put the offer or bid into the market and you cancel it before someone has a chance to take your offer or take your bid, then it doesn't matter. Okay? You just cancel it. Which means that limit orders are not necessarily permanent. They can actually change. A limit order could increase in size, It can decrease in size. It can be canceled altogether. It can be changed and modified. But as long as it's here and it doesn't get canceled, it's available. And there will always be bids and there will always be offers no matter what. The market, it will not function unless there are bids and offers available. Okay, so that's why they have actual groups of people who are designated as liquidity providers. Some people call them market makers, specialists, but whatever they're called, they're people who are obliged to become the buyer of last resort, meaning that if no one else is willing to buy, they will buy. And if no one else is willing to sell, they will sell. Okay? But in general, you don't have to worry about that because the market's so liquid, there's so many people trading it that it's relatively easy to find a buyer and a seller at any given time for the majority of the major stocks. When you get into smaller stocks that barely ever trade, that's where you're going to have difficulty getting into a trade. Okay? So, market orders interact with limit orders to create price movement. All a chart really is a track record of the order flow right here. So in other words, the very information you're seeing right here, including the time, the price, and the size, not including this last part, the market doesn't really matter, but the time, price, and size, all this information is used as is summarized basically in a chart. So a chart says, okay, of this stream of orders that occurred at the time index 1512, right? If I have a 1 minute chart, for everything that occurred which has a 1512 as the start, what was the highest price that traded? What was the lowest price that traded? What was the opening price that traded? And what was the closing price that traded? And what was the total volume of shares? That's the volume down here, of course. That tracks the total volume of shares. So these numbers are being added up to create the volume bar down here. And these numbers are being monitored to shape the candlestick, to tell us what the candlestick's going to look like. So that's how the market works, folks. In simple terms, or the simplest terms I can give you, all a chart is a track record, a summary track record of what happened here. But it's not, this chart cannot tell us every little detail about what happened here. It can't tell us which price in that 1 minute time frame got the most trades, or how were the trades spread out? Were they in really small, one share at a time? Were they 300 shares at a time? The candlestick chart doesn't tell us that detail. All it tells us is what was the summary. How high did it go? How low did it go? Where did it start? Where did it end during a period of time? And how many shares traded in total? Okay? That's all we know. Now, this represents the actual transactions. Remember, the time in sales means a trade took place. This is where a buyer and a seller matched up. But over here, these are potential places where orders might take place later. In other words, the bid and the ask are the available prices which are getting executed now, and the bids that are lower and the offers that are higher, these are potentially going to be executed later. So the market direction that we see on the chart, the shape of the chart, is a direct testimony to the shape of the order book, meaning that in the interaction of the order flow here, the time in sales, with the order book here, what you see on the screen, the chart, is basically showing you how those two things interacted with each other today, creating the movement that we see. So if there's a massive stream of buyers here and they just keep coming and coming and coming, more buyers and more buyers and more buyers, then you'll see a chart that mostly is going up and going up very consistently. If you have buyers for a while, then you have a lot of sellers for a while, then you have a lot of buyers for a while, then the chart will be back and forth a lot. And if the offers are really large but the bids are really small, you'll notice that the market's going up very slowly, but it can go down a lot faster. meaning that if bids are very tiny but offers are very large, the market will have a more difficult time going up because there's more weight pushing back against the price movement. But when you go down, because there's not a lot of resistance to the move down because the bids are smaller, the market will tend to drop faster than it goes up. Okay? So, in summary, everything that we see on the chart is the direct consequence of the interaction between order flow here of market orders and limit orders there. Simply, that's it. But here's a question. If this is the result of taking this information and summarizing it, what would happen if we were to take this information from the order book and do something similar where we actually track all the changes that are occurring on a time basis for each of these quotes? Like, in other words, when do people say they want to buy more shares or sell fewer shares? What if we could track the changes in the order book and map it out over time? If we did that, that's called a book map. That's the name that the company that came up with it calls it. So let me show it to you. It's actually also known as a order book heat map. It's the same thing. Here, let me just show it to you so you can see it for yourselves, okay? So let's look at Bookmap. Now I'm using Bookmap on Thinkorswim. Thinkorswim, of course, is a trading platform. So I'm going to put Apple here, and for just for illustrative purposes, I'm going to put the Nasdaq futures just because I want you to see something. All right, so here's the order book, right? This is called Bookmap, and it's showing me an order book for Apple at the top and the Nasdaq at the bottom. Let me actually arrange it this way. That's better. Okay. All right, so everyone sees this. Now, this is not going to be easy to understand, so don't worry about it if it's confusing at first. Just just bear with me, okay? Um, so, actually, you know what? Let me just pull this one over. Okay. All right, that's it. Let me just rearrange this for a second. Okay. This is going to be easier because I already have the data loaded, so I don't have to do it again. You guys see these two big lines up here? Everyone see these two big lines on the right hand side? They're kind of dark orange color. That's what it is. You're absolutely correct, Jorge. You're actually seeing the internal workings of the market. So remember, this is a map of this right here on the left. It's a mapping, it's like a chart of the order book. Okay, it's tracking just like the time and sales data can be converted into a price chart, a candlestick chart, a bar chart. What Bookmap does is it's converting the order book information into a chart, a visual representation of it. So here's what it means. When I see a line like this, and I see that it keeps going back in time, so in other words, as I scrunch this day together, the stuff in here is actually the trading. So this is like a price chart. I know it's a little difficult to see, but there's a price chart there in the background. And if I zoom in, you can kind of see it. You see on the left-hand side, it's easier for Apple because the orders are more spread out, right? Whereas on this, the Nasdaq futures, you can notice that the orders are very clumped around wherever the market is. So stocks and futures and also ETFs and futures contracts, they tend to have clustering close to where the market is. In other words, the orders tend to clump very tightly around the price movement. So as the price goes up, the orders go up. As the price goes down, the orders go down. In other words, they just keep tracking it on the edges all the way through. But sometimes you get a level that shows up like this one and this one. And what that represents is a persistent order or set of orders that actually want to do something, meaning that the people who are trying to sell up here, they're not just moving their orders to track the market. They're saying, we will only sell. I am recording it. I will only sell if the price gets up to here. I'm not moving around. I'm standing firm, right? So that means they're not negotiating here. They're standing their ground and saying, if you come up to here, we will sell. Okay, that's what these lines represent. Now, in indexes, whether it's futures, I'm not sure what's going on with the audio. Maybe it's clipping out at the top, but I can turn down the gain, I guess. Is that better? It might be the gain. All right, but either way, I'm just turning down the audio so maybe it doesn't clip as much. Okay, so when we look at this, okay, I got it. When we look at this, orders that persist, that just stick and they don't go away, are the ones you want to pay attention to. The orders that constantly change and move with the market, they are influencing the direction of the market, yes, but they're not the ones you want to focus your attention on. Okay, at any given time for a stock or a futures contract or ETF, there are going to be bids and asks that just keep tracking the market up and down. Market goes up, the bids and offers go up with it. The market goes down. There are people who basically just move their bids and offers around the price all day. Those aren't the people we're interested in. We're interested in the ones who hold their orders at a specific price and they have those orders in size. So this is a heat map. The darker the color is, the more orders there are concentrated. If you can't see anything, it doesn't mean there are no orders there. It just means they're being eclipsed in size by these. These are so large. Yes, 175 is a wall. It doesn't look like one, it is one. For Apple, that's correct. It actually is a wall. So over here, when these levels show up on a futures contract or an ETF, pay very close attention because they're basically screaming that something is happening. Now, you may be wondering, well, what's this stuff over here? Everything to the right of that horizontal blue line is just what's happening right now. In other words, these are levels that are forming right now, but they're not formed yet. So it's like a paintbrush that's still painting. What is already painted is there, but the brush is still moving. So therefore, what's coming up is just showing, what might be coming up. So these are currently quotes that are coming in. Sometimes they're bigger, sometimes they're smaller, but they're eventually going to be archived in this chart once it's done. So it's like when you look at a price chart, a regular price chart, and you see the bars, like the candlestick bars, the one that's currently forming, it changes shape and size, right? The ones that are already done, they don't change ever again. They're set in stone because what happened is already done. So to the right is the present, and to the left is what's already happened, just like any other price chart. All right, so let's focus our attention on Apple because the picture is much clearer here, and that's generally going to be the case for stocks. Stocks usually have very clear, very obvious levels. Indexes usually are much more fractured and fuzzy, which makes them harder to trade. This is one of the reasons why I tell you guys, if you're going to trade indexes like the NASDAQ, QQQ, stuff like that, TQQQ, SQQQ, if you're trading ETFs that are based on indexes, they're going to be difficult to trade because they're not going to be clearly indicating where buyers and sellers are. There's a good reason for that. I don't have time to get into it, but basically the reason summarizes like this. when you're dealing with an individual stock, it's one stock. When you're dealing with an index, it is a large grouping of stocks, which means that there are lots of little things that are happening inside of those stocks that are going to make it more difficult to place where the market should go. In other words, it's easier for me to know where a big buy level should be for Apple versus the entire market. The more things you have, the fuzzier and less consistent things tend to move. Now there's some positives for that. In other words, things that don't move very far, very fast, they're good for options trading if you're selling options. But things that move quickly and have clear levels, they're better for directional trading, meaning that you're much more likely to spot a reversal in Apple using this information than you'll ever be doing it with the NASDAQ. But if you happen to get a level like that one on the NASDAQ, rest assured there's a good chance it may reverse, and it just did. So the market went up to that level. Sometimes it's able to get through it. So in other words, these are not guaranteed not to be breachable. In other words, there's a strong wall can be still breached, and this is a strong wall, and it did get through the first one. It almost got through the second one, and then it reversed. So if I'm looking for a trade opportunity, whether it's this or something else, if I see the markets coming up to this wall, the one thing I have to accept is that maybe the trend will still keep going up later, but there's a very good chance that this is going to be the place that's going to move the price down. So it's going up in a trend, it's going up in a trend, but when it hits this level, it's absorbing so much of the buying pressure that inevitably you might get an excess number of sellers left over versus buyers. The market comes down for a bit, and then maybe it turns around and goes back up to there and continues. So this pattern that we just saw, all it is exhaustion. The market ran up against a very strong level. That level repulsed the market downwards, and then it starts to come back up later. And that's precisely, let's zoom into Apple. That's precisely what happened to Apple. So all day long, and I want you to get this point from the moment the market opened and before the market opened. 175 was a major price level, and it still is. This number over here tells us a number. It says 716,425. That literally means there are 716,425 shares at and around the price 175 that are awaiting to be sold by the people who are making the offers here. And that level is not new. It's been around for the last week and a half. So anyone who looked at this every day over the last week and a half, you would have seen that there was a large offer sitting at 175, and it just kept getting bigger and bigger as the days went by. Started off in the 300, 400,000 range. Now it's at 700,000 shares today, which is up from where it was earlier today. It's about 100,000. It's nearly 100,000 more shares now in size. And keep in mind that while the market was pressing up against this, it was taking away from those offers. In other words, every time a buy occurs, you're removing an offer. So, or part of an offer. So as buyers kept buying in, offers were being taken away, and yet the number here wasn't getting smaller. It was getting bigger, meaning that as soon as the market got there, we found out that there were actually more shares that were going to be sold at that price, but they weren't being advertised at first. Only part of the order. So we don't even know what the maximum number of shares that will come into this order will be into that one price. We only know what's visible now. And what's visible now is massive. Well, that's also correct, Jonathan. The market tends to go to wherever it can go. But the problem here is that unlike the previous rungs of the ladder, as I like to say, where the market just climbed through one, two, three, four levels, like it just goes through them, the smaller ones, still has to, it still gets pushed back. If you notice, every time you hit one of these levels, there's a tendency for the market to pull back. Then it goes to the next one, it pulls back. Then it goes to the next one, it pulls back. Then it goes to the next one, it pulls back, then it goes to this, and bam, it hits the wall. Okay, if you don't see it on Thinkorswim, you don't have it yet. So what you do, Leslie, is you go to support and you go into live support and you say, please enable Bookmap for my Think or Swim. Thanks. And then after that, when you hit send, they're going to come back later and say, do you already have a subscription or would you like the free version? And you just say, I want the free version. And then once you get the free version, you'll be able to look at Apple, Microsoft, and the E-mini S&P futures for free. If you decide to pay for it, which I do, it costs $40 a month. They'll debit it directly from your account balance. Yep, you're right. So basically, as Jen pointed out, if I just scrunch this down some more, guess what I'm going to see? More levels. And lo and behold, as I go up the ladder, there it is. Big one at 180, 432,000 shares or so forth, right? So notice that below you don't see anything comparable. All the liquidity is up here, not much down there. So, is the price ever adjusted on the wall of shares? I'm not sure what that means. Is the price ever adjusted? I'm not exactly sure what you mean price adjusted. Are you saying can these shares can they move from 175 to they can move around, sure, if they want to. So just make sure you're clear about something, Richard. Anyone can change their bid or offer if they want to. What I'm saying is we're looking for the ones that don't change. Does that make sense? We're looking for the ones that don't move. They stay there. Okay. So it's not that they can't move, it's that they're not moving. They can move whenever they want. They can cancel all of these orders if they want right now. They don't have to be there at all. The volume profile is different, Leslie, for one major reason. The volume profile is what's already happened. This is what may happen in the future. This is looking forwards. The volume profile looks backwards. If they cancel this order, maybe. I don't know if it would or wouldn't, Jonathan. I can't say that. But here's what it would mean. If they cancel this order, if there are any big buyers in the market that really want to buy in large quantity, now they have to buy at a higher price than 175 because the next level is 176, and that's 132,000 shares, maybe 133,000 roughly. And remember, these are not the exact prices. 175 is the center, but the orders are actually clumped around it. So like the peak of the tower is 175, and the sides are different. So you're right, whoever said it's like a volume profile on the right hand side. That is a volume profile, but it's a volume profile of something that hasn't traded yet. It's something that may trade in the future. That's correct. That's what it is. That's exactly what it is. So the reason why I like this is better information than the volume profile is that I can anticipate where the market may change direction or at least meet resistance before it actually gets there. With a volume profile, I'm looking at where the market's already been before and I need it to come back to that place in order for me to anticipate that maybe there might be some resistance there. So there's nothing wrong with the volume profile, but let's face it, past information is not as valuable as potential future information. Uh, if it can be derived from level two, well, this is derived from level two. That's where it comes from. but it's the entire book. It's not the level two just shows you all the top of the book as we call it for each exchange. The top of the book means the bid and the ask for each exchange. What's the highest bid or lowest bid? Or sorry, what's the highest bid? What's the lowest offer? That's what actual level two means. This is not just showing that. This is showing every level. In other words, let me just show you what I mean. If I scrunch this together, the vertical scale, eventually I won't be able to compress it anymore because eventually I'm seeing the entire order book. So apparently 220 a share is the top of the book, the full thing, and about 130 a share is the bottom for Apple right now. There might be orders that are lower than 130 and higher than 220, but who cares? The point is, we can see that most of the liquidity is concentrated just above where the market is now, but you don't see any big levels below, and you don't see any big levels above about 180 down. So basically, there's a level here, 147, 185. There's a slight one there at 190. And there also are orders in between these levels. They're just not, the heat map is designed to basically, the way I have it set up, is to filter out the smaller stuff. If I pull this slider to the left, you'll actually see everything. But I don't care about everything. I only care about the bigger stuff. Does that make sense? I really don't want to see every measly order that's in the market. I don't care about Mr. 100 share guy. I care about Mr. 100,000 share guy. Does that make sense? Everybody follow? Okay. So if I stretch this out, I only want to look at what's nearby. I don't really care about 180 unless we're getting close to 180, but it is nice to know it's there, right? So this is roughly where we are today. So every time the market's gotten close to here, when it probed its way into there, all that happened was instead of those orders going away as people were buying tens of thousands of shares into that area, all that happened was they kept re-upping more offers. More offers came in to sell. So as soon as you took out one, it was replaced by another two, basically. You can put a stop loss. There's a video that I explain how to add stop losses. It's on our YouTube channel, Joseph. So just check that out. It's actually on our YouTube channel for Funder Trading. It explains how to add stop losses, things like that, including automatically adding stops. Okay, so in short, let's just summarize this really quickly. Basically, what we've covered is that Bookmap is a running history of the persistence of orders on the order book. Persistence just meaning if they stay there and they don't go anywhere, that's something you want to pay attention to. That's someone signaling to you very clearly that if you want to play ball, here I am. If you want to throw something at me, here I am. Now, the market tends to move in the direction of where the liquidity is, meaning that if buyers have to buy, if I'm a buyer in the market and I need to buy, I got to find someone to buy from. And if I buy large size, I have no choice but to buy from someone who sells large size. Okay. Joseph, I just said, look, there's videos on the Funder website. Yeah, that's the one. But yeah, their videos they'll be labeled stop losses. Do if it is a large sell order, it shows red gradient. No, no, it's no, the gradient is always red. Darker color, whether it's a buyer or sell, Deborah, it doesn't change color based on that. It changes color based on the density of orders. So dark red is the strongest density. There's a color gradient here. You can kind of see it. The dark red is the highest density, and black would be the least density. So I have mine set on this scale, so that way it's easier to see. If I see dark orange or red, then I know there's a lot of stuff there. Also, of course, you'll see the spike on the right to let you know that there's a big order there. Okay. All right. So, any questions about stop losses, etc., please go to the YouTube channel. I'll explain. All will be explained there. All right. So, market right now is coming up to this area, right? And here's what we don't know. A sell order doesn't mean people are going short. It just means they're selling. We don't know if they're short, they're going to short sell, or they're selling for other reasons. But it doesn't really matter, Leslie. As long as they're selling, the effect is the same. So whether a person is short selling or just selling, it's still going to push the price. It's still going to resist the price going up, right? So let's just go back to the point here. So as the market approaches this level, there's only one way to get through it. Now it's 881,000 shares. So it just keeps getting bigger. This may actually pass 1 million shares by the end of the day, which I will say I don't think I've ever seen a 1 million share offer ever in my life. I don't think I have. So I would be interested to see if it actually does that. And if it does, that'll be very interesting to watch. Okay, so the market has to chase down wherever it can go. If there's no major buyers or sellers nearby, the market tends to drift around randomly. In other words, stocks tend to have little directional bias when there are no major orders anywhere. If you've ever seen a day where a stock makes sharp moves up, then sharp moves down, then sharp move up, then sharp move down, if you were ever to look at it on this, you would probably see that there was a big level above and there was a big level below, and all that was happening is the market was ping-ponging back and forth between those two levels. Not enough volume to get through either of them, but enough that it was worth for buyers, they buy up to that point, and then for sellers, they sell down to, whatever point they need to sell to. But any day there's a good trend where stock keeps going up, it's going to be breaching level after level after level after level. And I can show you an example of that if I can find it. Where'd it go? Hold on. There it is. Let me show you an example of that. So here is Netflix today. And we know that Netflix was on a really good trend, right? So here it is. This is the start of the day right here. Netflix goes up through one level here. You can barely see it, but there's a little level right there. There's a little dark orange. It's barely visible, but it's there. And later on, some other orders were placed there. Now, the way this works is when you see these lines, wherever the market was at the time the line appears determines whether it was a bid or an ask. So in other words, right here where my cursor is, that line is an offer, that's an ask, and this line below is a bid. Okay, so this doesn't it doesn't make any distinction in color between bids and offers because it doesn't really matter. All it shows you is where the levels are. If you're below the level, it's an ask. If you're above the level, it's a bid. If it breaks through the level, all that's going to happen is they'll probably go a short distance and then be done. That's my guess. That's what will normally happen because we're at the end of the day. But if it doesn't do that, then you probably are going to get a run for another dollar plus. So only one of two things will happen. Either it breaks down. It's like, it'd be like the athlete that makes the last lunge at the end of the day or at the end of a race, and then That's it. And they're you ever seen like a race where people are running an endurance race, they get to the end, they make that last big push, they get over the line, they collapse. That's most likely what will happen to the market. It will just exhaust itself getting through that last big level, or maybe it has a lot more left in the tank and it can go for another round. Who knows? But most of the time, it exhausts itself when it goes to big levels like that. Okay, usually that's what's going to happen. That's a very large level, guys. That's not like 100,000 shares. That's nearly 1 million shares. Um, are you referring to me? Apple's 30 setup automatic trailings order. You put. I'm not. Yeah, that's right. So that's. I'm not sure if what the question was, but Apple's daily volume is, yes, 50 something million shares, and 1 million share offer is huge. And Bookmap does cost $40 a month if you get it. That's correct. If you pay for it. If you get the other one, it's free to see Apple. Yes, you can get it outside of TOS as well. But yeah, if you want to use Bookmap to see anything other than Apple and Microsoft and the E-mini S&P, you'll have to pay for it. If you don't want to see anything other than Apple and the E-mini S&P and Microsoft, then you don't. I pay for it, so yes, it is. But again, you have to learn how to use it first. So rather than paying for it first, learn how to use it first and then pay for it. Now, but going through, let's just stay on topic for a second. So Netflix moves through one thing after another. The point of me showing this is not about you necessarily using Bookmap, but I'm trying to show you how the market works, that it is based on order flow. So when you see a stock trending up, it's going through level after level after level after level. So here's Netflix, hits a level, pulls back, hits another level, pulls back, hits another level, pulls back, hits another level, pulls way back, hits another level, pulls back a bit, goes through that level, hits another level, pulls back, hits another level, pulls back. Now it hits a level below, pulls up, hits a level below, maybe pulls up. But my point is, all the things that you're seeing is just the market jumping from one liquidity hotspot to another. If there's still buyers left, it goes to the next one up. If there are no buyers left, it goes to the next one down. And if people keep selling, it goes to the next one down after that, and so on and so forth. Everything that you see every day, all the time, is the market jumping from one level of liquidity to another. That's it. There's no secret sauce, which means that if I look at this chart, I can see all the points that were hit. But if I remove this chart and I look at a regular chart, which is fine, nothing wrong with the regular chart, but if I look at it, what can I see? Do I see anything here that told me ahead of time that that might be where Netflix is going to hit and come down? Did I see anything there? No, but I can see it on the order book because it's visible. I can actually see the price, or sorry, the orders that are sitting there. Now, this information here, when the market gets close enough, you're going to see it on the order book that we have there. So you still, all of you have this information that's here. You can actually see it in here, but the difference on Bookmap is it keeps a track record of it, so it's easier to recognize visually, whereas this is constantly moving. You may not notice that there's a big order creeping up and down, but it's still there. So if we approach on Apple, actually we just did, so let me pull up Apple. Hold on. Here's Apple. So we just pulled up to that level again. Okay, once again, we're there. And if you look here on the screen, you see that? It's moving around a bit, but you can see where my cursor is There it is, 400,000, three. It's right there, but it's moving so fast that you might not be able to visually keep your eyes on it. But basically, where my cursor is moving around, there's a big order sitting there, 360 something, right? And that's exactly at 175. But then there are other orders that are around there too. Now, as this price gets closer to the top, you're going to see there you go, 126, etc. I'll explain another time why you can't see. Okay, looks like we're hitting. Did we get through it? No. Yeah, we did. All right. So it looks like, yeah, it looks like they bought the farm on this one. So yeah. Now I think some of those orders got canceled, to be honest, but whatever the case may be, it hit it, and right as it was going through it, it looks like they took out about 500,000 shares. I think the other part of it canceled. So now we're going through. Now, the question was asked, so what's going to happen when we go through it? Well, it's based on what I'm seeing now. Yep, that's correct. So now that we're going through this now, the main question we're going to ask is, does this look like it's got super high momentum to keep going? My guess is probably no, but I don't know. Is that a sell imbalance, Jorge, or a buy imbalance? Is this showing up as a buy or a sell imbalance? I'm not looking at. Okay, so then okay, that makes sense. Then I get what they're doing. It's pretty smart. Anyway, so here we go. We're moving up a little bit. This is not what a big breakout looks like usually. This looks like we're basically the engine is stalling here. So that's looking like it's going to stall. But this is fairly normal. So in other words, I would not buy this right now because it would be too much of a risk. It doesn't look like it's ready to go through. Generally speaking, when a big level is broken successfully, the market just explodes through it. You'll see a big spike on the other side. It'll pull back just a teeny bit and then immediately start to go up. So this might still do it, but I don't know. It looks a little questionable right now. And so I would put this as not looking that great. Okay, so in other words, the odds are too iffy that that's going to succeed to keep going up. Now, could it go down? Sure, but we've already done that before. So for me personally, with 8 minutes left to the close, I wouldn't be looking to short sell right now. I'll just leave it alone. Okay, so exactly, Scott. So you saw the difference. Like, Nvidia also did that today, or Netflix, or it was, I think Netflix did the same thing. It broke through a level and just kept going right away, like no hesitation, no, I'm not sure where I'm going. It just broke through and just started sprinting. So it's like, I don't know. The best way I could describe it is that like it's like someone just broke through, like a good running back just broke through a wall of defenders, and they just pick up more steam. Now that they're free. Let's see where research screening. How to find. You don't, Steve. You're not going to have a hunch that's going to run like that. You just find out. Like I said, guys, forget about this idea of you're going to get a hunch that something's going to move really big today. It's a waste of time. There's nothing that's going to tell you that. Only thing you can tell is something looks like it's going to be very active today. You don't know what it's going to do, but you can definitely tell if a stock looks like it's going to be active. And the stuff we look at pre-market, they're already moving pre-market, so we already know that they're probably going to move after the bell. We just don't know if they're going to keep going up or if they're going to sell off. But we do know they're most likely not just going to sit still. So forget about trying to find out which stocks are going to do that. You're not going to. Just you have to look, search, keep the scanner running, look around. You see what's moving, you jump on that. I mean, it's always going to be work. You're always going to have to wait and find out. So that means that if you don't see something moving well, skip it. Don't sit there staring at it, waiting to find out what it's going to do. If it's not doing anything, move on. Okay? So there are no seasoned traders that can tell you, hey, today Netflix is going to move up big time. How on earth could they possibly know that? Who's going to tell you that? When it takes a large amount of market participation to move one stock. So there's no way one person or one group of people would know that unless they control the market. Martha Stewart, maybe, but keep in mind, guys, you would have to know information that no one's going to tell you. That's my point. Like, why would someone give you that information if they had it? I mean, even me personally, I'll freely admit it, if I had that information, not to be mean, but I wouldn't give it to any of you because that'd be worth too much money. Got it? So don't look for it. It's not there. I got it. It was a fair question. All questions are fair, but I'm just telling you, forget about it. Yeah, anybody that tells you they can figure it out what's going to happen the next day, I'd be asking, so why are you telling me this? I actually wouldn't even ask. I wouldn't even listen, to be honest. So, I'm not at the point where I even want to engage that conversation. Anyway, so politicians and people like that, of course, they know I'm not in that group. If someone drops a hint to me, I'll take it, but I'm not expecting it, you know. But if Senator XYZ said, hey, by the way, I don't know who you are, but we're about to vote on this bill, it's about to pass. I'm like, oh, okay, thanks, and move on. I would have to deny I ever heard that conversation though. All right. Anyway, um, sorry. So Apple broke through, but just barely. Now it's just basically stuck. So this was the scenario that we thought was most likely. The runner got through the tape. They made their last push in the race, and now they're like, I can't run it. I can't run another inch. They collapse. And that's basically what happened so far. We got 4 minutes, so you never know. Maybe it has something left in the gas tank. But guys, this is really how markets work. This is the inner workings. This is the scene in the Matrix where you're looking at the code. That's it. Nothing else. So what we need to get good at is observing when you see a stock that's on a really good trend. If you have Bookmap, look at the stock on Bookmap and take notes about what you see. And the more times you do that, you'll notice that there's simple patterns, that stocks tend to move through levels that are above or below when there's a good trend. Liquidity tends to show up in front of the trend. In other words, as a trend keeps going, more buyers, more sellers start to show up. Why? Because they're trying to catch some of that movement, some of that momentum. So if I need to sell and I see a lot of people buying, I'm suddenly going to say, "Hey, I'll sell. I'll sell." Put it in front of them, right? And I'll layer my sell orders upwards to get as high of a sell price on average as I can. If you're wondering why these are getting thicker right now, it's because we're at the end of the day. People are posting bigger orders around the market to try to catch some of the last minute volume that comes in. And you said there was an order imbalance. Where is my, oh, sorry, hold on. I got to move this aside so I can see it. There we are. Let me look at the imbalance. Yep. Well, Apple now has 400,000 shares to sell, so it's not too bad. That's about normal. But if this doesn't go away in the next 2 minutes, then yeah, Apple's price will likely drop right at the close. That's usually the way it works. So we'll see. Imbalances are just pending orders that will be executed on the close. And if there's too much of an imbalance, then not enough people to match it, then the market has to move. So 460,000 is actually a good number. Apple's actually moving up right now. Interesting. So let's see, maybe, I don't know. It is moving up right now, barely. So we'll see. Anyway, so that kind of concludes Bookmap. Okay, so all Bookmap is, it's a visual history of the order book, lets you know what's been there, how long it's been there, and how big it is. The more persistent an order is, in other words, the more it sticks and doesn't move around, the more serious the person or persons who are posting it are. So therefore, you can realistically expect movement to occur based on those orders. Yes, I've recorded this. It's recorded. All right, so at the close, Apple's imbalance dropped to 125,000, still significant. Notice that the orders are evaporating. Okay, so they're now gone. All those orders that were sitting around, now they've poof disappeared. That's normal because no one cares after the market's over, right? So once it's done, it's done. So the imbalance is hold on. Actually, correction. Apple did not close with a 100 and something thousand imbalance. It actually closed with a where is it? Okay, I don't see it on here. So I guess they matched it. I guess that means it was matched. I don't even see Apple anymore on the list, so I guess they matched the entire imbalance. So the largest imbalance that was left over looks like it's ELDN, which is a no-name stock. So the big stocks usually they don't have imbalances that last forever. There's always a buyer or a seller for Apple. Exactly. All right, folks. So now I did promise I would go over one person's um, Um, I did promise I'll go over one person's prop reports, so let me just do that really quick. I do have to conclude pretty soon here, so let me just do that for the next 10 minutes. Um, that was Gary, TR, TR47, okay, sorry, TR478, AC5. All right, Gary, let's see what we got. On the imbalance chart numbers, no, mine shows blue for buy imbalance and red for sell, but you can change it. I think the default settings are blue for buy and red for sell. All right, so for Gary, let's see. All right, I mean you're not looking too bad, my friend. You got a 3-to-1 win to loss ratio. You got a 30.20% bet. So you want to increase your bet. So in your case, I think all you really have to do is this. Your win to loss ratio doesn't have to be this high. Um, you don't have to have a 3-to-1. It's going to be, let's just put it this way. Your win to loss ratio in my strong experience should be somewhere between about 1.4 to 1.8 to 1. When you're at much higher numbers, it's harder to actually make money because you'll have too few opportunities that qualify. And if it's at too low of a number, obviously you lose money. So if you have a really high win to loss ratio, you'll probably win anyway, but you just won't win a lot because there won't be too many. So your win to loss ratio, you might want to, and here's what I would examine. Look closely at your trades. I know you've looked at them, I'm sure, to get that win to loss ratio, but the check out how far the market usually goes in your favor at maximum and how far against you it goes at maximum for your average trade. To do this, you're going to have to do an actual serious investigation more than probably you've done already. What I mean by this is every time you get into a trade, imagine that you had a chart, like a bar chart, and it tracked the high, low, open, close of the trade over time. What you're trying to figure out what was the high point of the trade. So to figure that out, you'll have to actually track it very closely. So at the end of each day, you review all your trades and you look at what was the peak at which my trades got to, the ones I was in. It's easier if you're doing longer term trading because you'll have like like when you're a fund manager, they track your drawdowns and your peaks, but they're based on the closing balance of a day, which is a lot easier to track. So intraday, when you go in a trade that lasts for a few minutes, like 17 minutes, and that 17-minute time span, there was a P&L maximum and there was a P&L minimum. You don't have to get it exactly right, but if you can guesstimate or closely estimate what that was, what you want to find out is maybe if you give it just a tad bit more downside, you might actually end up making more money. In other words, it might possibly be, and I can't say this for sure, but you might be cutting your losses too quickly. In other words, you might actually see that most of the time, if it goes down, the maximum goes down is like $20 before it can move strongly in your favor. If that's the case, then so be it. If you've already investigated that, then I'll move on to the next suggestion. But that'll be the first thing I would look at on an individual trade basis. Let's just see if we can examine one for illustration. Here, let's just try this. All right, let me go to. That was a good day. Um, let's go to Tesla. Okay, let's go to this one. Right, so that was on the 17th at 10:27 Eastern to 10:59, and you're along at 171.865. Okay, let's take a look at that. Well, honestly, Gary, honestly, I wish most of us had your problem because if most of us had your problem, it'd be a lot easier to get to profitability. You can make money right now. Count that as a huge plus that you actually can end up positive at the end of the day. That's not a small accomplishment. That's something that's a really big deal. You if you can do that because now you're working from a position of advantage where you can just work on dialing back your stop losses to where they're dialed in correctly. Much better than trying to do the opposite, right? All right, so for Tesla, you got in, and I'm just going to guess. I think I know where you probably got in, but let's see. 1027. Yep, good entry. Good timing on the entry, by the way. Very good timing. You did exactly what I recommend. Pull back, starts to go up. Perfect. All right, so you got in here. Now this one didn't really go against you at all. so I hear you. Like this one, it's probably not the easiest one to analyze because it just went your way right away. But hmm, I have to find an example. Do you remember any trade where it really went against you a little bit first? Like any trade that you got into recently? Not today though. It has to be before today so I can look at it. But something you got into that it went against you. You got stopped out at about 14 bucks. Yeah, okay, I figure that. Okay, that's probably not helping. But let me see if I can illustrate my point. So let's suppose that I know you didn't do this, but let's suppose you got into the trade right here, okay? And it stopped you out, and then it starts to go this way. What we want to know is how far down did it go first? And you could just look at the low if you're buying. Just look at the low of each bar for a 1 minute basis. Like, okay, so if I bought here at the close of this bar, that would be the P&L swing low, and then we want to see how far it went up. So you also just you want to get a sense for whenever you do a trade on the setups you're using, which you're using the same thing I would do, so that's good. If you're doing that, you want to get a sense for how far things usually go against you versus going your favor, and that should give you some idea of how much risk you can actually afford. because if I find out that if I let a trade go against me maybe $28 instead of 14, and I get better overall results, then maybe that's a good idea to do that. I just have to look. You just have to see the numbers, and also more importantly, don't just look at where you exit, but also look at how far the stock usually goes in your favor on those trades on average. So one of the easiest ways to know if you've got a good buy entry strategy or sell entry strategy is to keep track of how far things tend to swing favorable versus negative after the signal comes in. DDOG, what day was that for? I'll do DDOG. What day was that? I'm glad you hate losing. There's nothing wrong with that. But think about losing more as a cumulative thing than a one-time thing, right? Cumulatively, um, the other thing is this. Um, actually, let me also point this out. The easiest way for you to actually move forward is here's what I would do. This is exactly what I would do. You're basically trying to calculate where the cutoff point for your trades would be to give you about a 40% win rate, something of just above 40%. So without it actually putting you into a loss. So in other words, if you go to a 40% bet, but it puts you into a loss, then that's not going to work. That means that we'll have to work on the specific timing of trades. Um, so in other words, if you change your risk profile to give you more risk, but then it wipes out your gains, then that can't work. So that means you should stay with what you're doing, but now you're going to have to figure out what trades to cut loose out of your strategy altogether. In other words, is there something that you can eliminate that doesn't tend to work out so well? It could be something as simple as averaging, using a different averaging strategy. Um, Usually these things come down to very small changes. Right. So I don't think that's a problem. It can't be a problem, but maybe you can adjust the entry strategy slightly. But I don't think that's really your issue. I don't think that's an issue for you. I'm not noticing that. What I would suggest, however, is you might want to modify your trade sizes because you're actually staying pretty tight. You're not losing significant amounts of money. When you have a down day, it's not like you're losing hundreds of dollars. Like your bad day is 119. So you can afford to increase your size. It'll take a little bit to get comfortable, I admit, because you're going to see numbers that you're not used to seeing. But gradually increase your trade size because since you're consistently keeping a high win to loss ratio, and I do think yours is the highest I've seen ever in this challenge. So if that's and I'm pretty certain that's the case, and you're still batting 30%, that's good. That's really good. So all you want to do now is maybe you want to gradually increase your trade size. Just get used to it. Maybe increase it by 10% every couple of days so you can acclimate to it quickly. And just remember that your losses are going to be double the size as what you're used to, but so are your gains. Just don't let it psych you out. Like just stay the course, do the same things you always would do. Just realize that the numbers are going to be larger against you. But you can afford to risk more because you're ending the day if you're down at 119. So it takes a while for you to build up that loss. That's good. I know you'll get used to it. Just the reason why it's hard to get used to is because your mind is already acclimated to, it's kind of like I'll use a good example. The first time you start to make any serious money in life, if you like for me, I definitely didn't come from money, like not even remotely. I mean, when I was a kid, we were on public assistance, so that's what I remember. But um, as time went on, there you go. Yeah, as time went on, you gradually acclimate to being used to spending more money. So like I have to admit, like when I think about now versus before, stuff I spend money on now, and I have to admit, if I thought about it back then, I'm like, holy cow, like you spent how much? But now it feels normal because I'm used to it. So to me now, spending less money would feel weird. It'd be like, this doesn't feel right. Why don't I have more money? And everyone gets that way. Once you get a little bit of success behind you in anything, you acclimate to success. So you no longer feel at home when you're not doing really well. And the other day I was driving through Chicago in my friend's car and I was looking around and I was like, yeah, there was a time where I would have thought it was a big deal if I lived here or there. I was actually about to crack a joke about it when we were getting out the car to go to a restaurant, that there was a building that was right there. And I remember when I first moved to Chicago, I was like, yeah, one day I'm going to live down there. These days, I'll look at it and say, that's, I'm sorry, I mean, not to be offensive, but I'm like, that's a shithole. Like, I wouldn't want to live there at all. But it's just, it changed that much where I couldn't even imagine living there, but I would be willing to if that's what's necessary. Um, so yeah, so you can afford to risk more. You're actually in a good position to do that. Okay, so just acclimate yourself slowly. Like I said, if you increase it by 10% every couple of days, that's not going to bother you. You'll get used to it. The other thing, again, track the degree to which things tend to go favorable versus unfavorable for you, because that will probably identify places where if you modify your strategy just a little bit, you'll get bigger overall wins. In other words, you may be exiting because the pullback occurs, but it's not actually a big enough pullback where you should be exiting. So look at that, and that should actually help to better acclimate you to what you're doing. But you're on the right track. I mean, yeah, just look at that, and hopefully you get some more big wins on Tesla. All right, all right. So I mean, I won't have a lot of time to do it, but I'll definitely look over a little bit of this. I won't be able to look at each trade or anything like that, but I'll run my normal analysis and see if I can figure out maybe if there's a way for you to. I think your side is not the risk side. You're not having an issue with that. I think it's just you might have more profits sitting there waiting that you're not getting. So we'll work on that. It's already in process. The platform manual actually am adding chapters to the part that they asked me to add it to. This is recorded. I haven't saved it yet, but anything I record is going to be on the YouTube channel. So I'm about to end the recording now.